bad actually. Given the kind of cues that we have, given the way global markets are under pressure, a flat opening is something that the bulls would take with both hands, and there it is. In fact, the mid-caps and the bank nifty are actually have started a tad bit in the green. So let's see how it goes from here. Nifty absolutely sideways this morning. That's the first tick. Now down about 20 odd points, but still hanging on to that 19,590 mark on the index. What's leading from the front is TCS on the back of that JLR order win. So TCS is up about 0.3%. ONGC, Maruti Suzuki, Kotak Mahindra Bank is picking up a little bit of pace. Dr. Reddy's, Tata Motors, Bajaj Finserv, HDFC Life, a couple of other stocks that are in the green right now. On the downside, Tata Consumer Products, we've been discussing that, on that whole Haldiram acquisition piece. So Tata Consumer down almost about 2% on the denial there. JSW Steel, Power Grid, Hindalco, LTI Mindtree, Apollo Hospitals, a couple of other stocks that are just about trending in the red. But suffice to say that this is a market that has opened absolutely flat. Little bit of a negative bias, nothing alarming. In fact, the advance decline ratio is still trending in favor of the advances. About 1,300 stocks on the advancing side on BSE compared to about 550 stocks on the declining end. So given the kind of subdued global cues, this is not a bad opening at all.
I guess it's a lot better than what we've seen across Asian markets. So the bulls will take this. Look at the way these EMS stocks are flying on that CLSA report. Keynes is up 8% straight away. I think CLSA's price target on the stock is somewhere around 2,200. It's already reached over 2,050. Amber is up 5%. Dixon is actually flat because in Dixon, Kotak has a contrary view. Kotak has a huge downside target of 4,000 on Dixon. So classic bull versus bear between CLSA and Kotak Institutional Equities playing out on Dixon as we see things. Paytm, Yash was telling us that sources are indicating they won't get into insurance. The stock is down about 0.5%. On Jubilant, there are some negative reports. I think it's Macquarie saying they're not quite convinced that this World Cup is going to bring so much of excitement and heightened consumption for Jubilant. That stock's slightly negative. Ind-Swift Labs. It is literally the curious case of Ind-Swift Labs. It was up 20% on circuit yesterday, announcing pretty much the sale of their entire business. Today it's down about 11%, so absolutely chaotic moves on that stock continuing. Beyond newsmakers, let's look at what else is catching the attention this morning. Some of the fertilizer stocks are still running. There were an active lot yesterday as well. Nagarjuna Fertilizer, for instance, up about 4%. Good volumes there as well. GMR Power, 3% on the upside. IRFC is at it again. 4% on IRFC. It took a break yesterday, bit of a breather. Back on the upside of the screen today. Lemon Tree Hotels, Castrol India. These are some of the other names where the gains are coming in quite quickly. Watch out for CG Power as well. Interesting move on CG Power, about 3%. We keep talking about, of course, a lot of action in the power space. That's a stock on the upside. Devyani, by the way, is up. Jubilant is down, but Devyani is up about 3% when we speak of QSRs. Interesting market, I guess. It's still down on the Nifty, 20 lower. But as usual, mid-caps have a mind of their own.
So is it like people order more burgers and less pizzas when they watch cricket matches? Is it like that? I mean, why is Devyani up?
But Devyani is up, so, not quite sure. But I think the expectation has been that as you get into the World Cup, people will go back to ordering QSRs. One of the brokers today are arguing, saying that you have Zomato now, so you have plenty of options.
You have plenty of options. You don't have to stick to the listed QSR space. But I think the space to be in this morning is the EMS companies, right? So whether it's Keynes Technology, whether it's Amber Enterprises, Dixon, all of these stocks. CLSA, of course, put out that note. Our colleague Sonal was telling us about that. Not Dixon, but Keynes Technology is, CLSA is very positive on this stock. That's 7% higher. Dixon also, CLSA has initiated an outperform, saying that the Indian EMS industry is expected to deliver a 22% revenue CAGR over the next decade. So even Amber Enterprises is the one that's looking good. Varick Engineering, by the way, the company has bought a 26% stake in a renewable energy company called AMP. In fact, there's lots happening in the EV space, not just Varick Engineering, Hero MotoCorp as well has invested in Ather. So EV space also picking up. But otherwise, not a bad opening.
Not a bad opening at all, Sonia. So 35 points lower. By the way, yesterday, the entire railway stocks all pulled back. IRFC and Texmaco and everything, basically. Titagarh, everything was down between 4 and 5% after the run-up. IRFC is starting back up about 5% or so. So that is one area where there has been a fair bit of retail activity. Amber, I think we highlighted 3.5% from that space, EMS space. Lemon Tree is up 2%. These are some of the big volume-led gainers coming up on the screen. EID Parry has been one of the names from the the Chola Group, which has not really done very well. I mean, actually, one of the underperformers, but that yesterday went up 5%. EID Parry is up another 3% this morning. Devyani, you guys spoke about. Keynes is up 7%. So I was talking about these paper and smaller sectors, right? Andhra paper is up another 2.5%. Sheshasai paper is coming up with a 4% pop. So yeah, I mean, there is some activity. Avalon is another one of those sort of EMS players, which is starting about 3% higher. Stocks at about 600. Piramal Pharma is up about 3%. Aavas Financiers is up about 2% or so. So this is the start as far as the broader markets are concerned. Tata Consumer Survey went up 4% yesterday in the last 30 minutes on the back of that news report about Haldiram. It's climbing down. It's down 2% on decent volumes. It's a top traded loser with price activity on the downside. At least that's what's coming up on my screen. And the other one is Ind-Swift Laboratories, which is down 13%.
Yeah.
That'll come up as well. Stocks at about 107 on volumes. Surabhi.
So, Prashant, all this while I was scratching my head literally to figure out why a stock called Responsive Industries is up on such heavy volumes, and it's up 14-15%. They make, I think, vinyl flooring and synthetic leather, and then went through the exchange notifications to figure out that they were making a lot of this for Vande Bharat. Now they have a contract for the Garib Rath, and anything that has anything to do with the Indian Railways in the market, flying away, and that's a stock worth noting. Huge volumes and price action today.
I think it's done well over a period of time as well, because it does come up occasionally.
Yeah, 150% up just in this calendar year. 2023, the stock is up 150%. It is also, among other things, it's also a railway play, and it's got another order for the Garib Rath, Indian Railways in focus.
All right. Well, the Nifty Bank is underperforming a little bit. It's down I mean, it's actually flat, not very much to complain. You got the Nifty, which is down about 35, 36 points still. Sandeep Bhatia is head of equity, India, and country head at Macquarie Group. Sandeep, good to have you with us here. Good morning. Thanks very much for your time. Just starting with the entire EMS space, the electronic manufacturers and a flurry of initiations, etc. Do you guys have coverage at Macquarie on these names, and what do you like there? At the margin, it also does seem to be that from just assembly, players are moving on to more value-added stuff. Go on.
Yeah, we have limited coverage there. We, of course, like the sector. And the real challenge is not, whether in the next 1 or 2 years we'll see expansion. I think the value-added portion, as you just mentioned, is critical. And the biggest chunks of value-added are mostly in semiconductors and optics, whether it's laptops or whether it is phones. So I think on that front, India is still some time away, and it would take at least 5+ years for some of this to come to India. And even there, the technology and the level of manufacturing and the kind of work which is done in Taiwan, I think even the US is over a decade away. So this will take time, in our view. It's right now just a question of the fact that this opportunity never existed in India, and it's come. So that's a good thing, and the stocks are essentially flying on the fact that this opportunity is now getting realized.
By the way, Devyani International, we were talking about that. It's now at a fresh 52-week high. So, that stock is up almost about, I think 5% right now. It's up 25% this year. Consumption is coming back in a big way. There are, of course, a lot of big events as well, like the World Cup, etc. But give and take everything, this has been a very good month for Devyani International. Now at 220 rupees, 52-week high. PBR Inox is at a fresh 52-week high as well, 1850 over there. And a couple of others. Indian Hotels is at a fresh 52-week high. So consumption across the board is doing very well. Sandeep, hi, morning. How are you feeling about the mid-caps in general? If you had high amount of exposure here, is this a time to be a bit cautious, or do you think that there is a long runway?
Well, I think we are at that inflection point of geopolitics meeting global finance as far as India is concerned, and therefore everything that has some announcement around it or some potential, potential government policy to promote it is moving. Should I invest right now? I would definitely be cautious. I think on these counts, I would look at value in sectors which have actually lagged. So I would definitely want to look at some of this. The entire mid-cap space, in fact, has really moved very fast in the last 2 months, especially, and we could see some more activity going forward. But for a longer-term investor who has a time horizon of at least 2 years, I think it's time to be cautious.
Time to be cautious. Okay, saying it out as clearly as it gets. Sandeep, good morning. Surabhi here. Good to be chatting with you today. So while, we take that advice on board, where are you getting, if I could say maybe a little uncomfortable right now? One of the biggest debates is on this entire manufacturing space where perhaps the longer term tailwinds are in place and we have seen a lot of spending, but then stock prices have also moved up. So is it capex, capital goods, manufacturing? Is that an area of concern or is it something else?
So to say that something is an area of concern per se, I think would be overstating your bearish or cautious case. There are, on a macro level, there are no concerns. If the stock has gone up 20% in the last 2 months or so, then clearly there is a concern on valuations. Is there necessarily a concern on the business model? I would definitely be concerned when there is no business model and there are fantastic billion-dollar valuations which are ascribed just to some business. And that clearly is something which one wants to reconsider. But the real issue is that right now, if you look at some of the large sectors, like banks have probably given their best performance in terms of numbers. The stock prices may still continue to move, which they should, because we are not in any down cycle. We are probably not even at the peak of the best part of the cycle. We are mid-cycle for banks. And to that extent, one can continue to remain invested. Pharma, again, suddenly after a couple of years, people have started looking at it. But again, I'm more cautious because it's more event-based. But yes, pharma is something which one could definitely look at. The real beaten down pack which people should look at is the IT sector. And here there are good quality names which clearly have not performed and not been investors' favorites. So I think it's time to actually look at some of these underperforming sectors and names.
Large cap IT, I presume, right, Sandeep? Because mid caps have just done very well for themselves.
Correct. Yes.
Okay, got that. What about power as a space? There seems to be a real case many are making that even as we kind of completely over the next many years move away to only building renewable capacity, we are at a point where that it's too big a jump to make immediately. So you will need new thermal capacity as well in the interim, and that the opportunity could be large. I mean, so we saw that announcement from NTPC. I think we'll see more. So just wanted your thoughts there.
So the entire manufacturing sector, construction sector, which requires steel, all these are in it. Even the services sector, in fact, artificial intelligence and everything also requires power. So I think the old-fashioned power is definitely there for the next 10 years, if not 20 years, honestly. That's why we see the global oil prices still remain firm. While the green energy transition is happening, the case for that in terms of wholesale transformation of the power sector is definitely overstated in all countries per se. So I think for the next 10 years, for a country like India, we have no option but to rely on thermal power, and to that extent, that sector definitely will see volume growth and expansion.
Okay. Any other spaces, Sandeep, where you think that there is both, price appreciation, valuation headroom, as well as growth coming back in a big way? Something that you can look at for the next 12 to 18 months?
I think the only sector which has some headroom and growth and price appreciation with much less risk is actually the banking sector. So all the private sector banks, HDFC Bank, which has been underperformer, can be looked at. I think next year it should definitely do much better. And that is one sector. The other sector probably is definitely the large cap IT sector. that is something which has actually surprised many in terms of the way it continues to be such a big underperformer. So I think we will see some inflows into the sector over the next couple of months, but it will be patient money which can wait for 2 years.
Okay, got that. Sandeep, one theme in the market has been, rock solid PSU moves. And we've seen that across the board. Even PSU banks, I mean, they've done better than their private sector counterparts, a lot of the railway stocks, defense, etc. As we get into election season, could populist spending or any kind of populist moves become a bit of a risk for the market as a whole or for PSUs in general? What's your sense on PSUs after this rally?
I think PSUs are coming back into fashion after a very long time. I think this unfortunately in India is a large part of the sector, a large part of the economy, and even potentially of the market, but which gets always, especially in the energy sector, they dominate. But they always trade at single-digit valuations. So my short answer is I don't see populism at the central level to damage valuations or the earnings story of these businesses. Populism is happening at the state level, but that will actually impact state finances. It won't affect the PSU businesses, whether it's banks or other PSU organizations. The only challenge is that we need policy clarity and stability for the longer term. And that even now, I think people don't have the confidence, even if the government, even if the BJP comes back to power again. And that is a major long-term challenge to valuations of this sector. And if that changes, that's a different thing. But I'm not betting on that. So to that extent, these are cyclical India story, India flavor moments which happen, and when they come in. I hope that continues for more than a year or so, because historical experience has been that these kind of moments are mostly short-lived.
Okay. Got that. Sandeep, good talking to you as always. Thank you very much for taking out the time and joining us on the show today. We look forward to the next chat. Well, that is a word coming in from our market master of the day. The market, by the way, is now a slightly deeper shade of red, 50 points lower. But again, if you contrast that with what's happening in a lot of the Asian markets, and this is still not bad, though, of course, we're not seeing any early recovery just yet. Mid-caps are relatively outperforming. Let's move on to our next conversation. Muthoot Finance is in focus. The company's asset quality had deteriorated a bit in the first quarter. Net interest margins were also under pressure. To discuss a lot of the trends that are now shaping up in the second quarter and what lies ahead, we have George Alexander Muthoot, Managing Director at Muthoot Finance. Mr. Muthoot, thanks very much for being with us. So, it's been interesting. I mean, one clear sort of trend is that in the second quarter, gold prices have been fairly subdued, I think, throughout the last several weeks now. Overall, what are the trends in the business that you're seeing, and how does that kind of tie in on the gold side of the business as well? What does Q2 look like so far?
Thank you, and good morning. I think Q4 of last year and Q1 has been quite good. We saw good growth in the AUM, gold loan I'm saying. Gold loan AUM, we saw good growth. We also saw good, the profits also we are able to sustain the profits also. So Q2 and going forward also, we see the same momentum coming back, going forward. We had given a guidance of about 15% for the gold loan growth. I think we will stick to that. We'll be able to achieve that for the full year. Now, regarding the asset quality, I think, which you initially said, that asset quality deterioration. For a gold loan company, asset quality or the NPA is never a barometer or never a check for the asset quality, because the asset is always gold, so good quality. So the NPA numbers which you see, if it is 3% or 4%, it's just time given, extra time given to the customer to take back his gold instead of auction. So that has never resulted in a credit loss for us. Today, our credit loss is always in the, for a year, it is in the range of 0.1%. 0.1% or less than that is our credit cost. So I think the NPA numbers which you see always is not reflective of the credit cost or credit loss of the company.
No, fair enough. I mean, you have super collateral in the form of gold, especially on the gold part of the business. Specifically on gold loans, your AUM was up almost 6.5%, 6.7% quarter-on-quarter growth in the first quarter. Again, I just asked, because gold prices have come down, how are those numbers looking now? What is the LTV that you usually run on the book? And is there a correlation? I mean, when gold prices fall, does this part of the business get hit in any way?
But it's not substantial hit or something. But first of all, I would like to correct you. The gold price is not fallen actually. Maybe a 2%, 3% fall in the price. That is always there. You don't call it a fall in the price, just fluctuation. And seeing the economic trend, international economic trend, etc., I don't see gold prices having a big fall, etc. It will only sustain or maybe gradually go up only. But because the gold price is higher, some new customers may be able to borrow a little more because our LTV is capped at 75%. So somebody who needs the maximum amount, he will get 75%. And if the gold price is falling, maybe a little less, but it is nothing substantial. We have seen fluctuations in the gold price, but overall, if you see a 1 year, 2 year, 3 year, 4 year trend, it is always rising.
Mr. Muthoot, good morning and thanks for joining in. So this 15% growth that you're talking about, right, for the full year, can you just tell us what kind of ticket sizes are you looking at? Is the focus now on low ticket size customers or high value customers continue to be the focus area? And, what do you see? Is this a sustainable growth, a compounded growth that you're looking at, 15 to 20%, say, over the next few years?
Yeah, 15% is what we have said. So when you ask about the type of customers, we have a lack of customers coming to our branches every day for a loan. And most of them may not, maybe 90% of them are the low ticket, maybe 25,000, 50,000, 1 lakh up to 2 lakhs. The high ticket, maybe 10 lakhs, 20 lakhs, 30 lakhs, big customers, probably they are not much. They come, but they are not much. But they would, if they are also, they would have a choice of going to their own respective banks also for the gold loan. But then, having said that, our customers, our forte has always been the low ticket, the general public who considers Muthoot as a good company and maybe a trustworthy company to give their gold to. So we have always banked on the low ticket customers, and our average ticket size today is only about 70,000 rupees.
Okay. Mr. Muthoot, hi, good morning. Prashant here. Hi. Could you tell us in the second quarter, what has been loan growth at?
Yeah, I think for the whole year, second quarter is also looking as good as the first quarter. So the fall, I think there can always be some months, some aberrations, or maybe going up, going down, etc. Overall, I think we will stick to the 15% growth for the full year. So this quarter also, we should see good growth. Yeah.
Okay.
Sustained.
Now, sustained at 15%. Do you believe, and we've spoken about this in the past, and you did last time you were on, you spoke to us about, I mean, you've got a small housing book, you're looking at SMEs, and you'd spoken about that in some detail last time. Is there a feeling within Muthoot that eventually the only kind of way to continue to grow is to diversify into other segments aggressively and very fast? Is that is there a feeling that you need to do that internally?
Yeah, I think. So I think the fact that you said we need to diversify, yes. Whether we need to diversify aggressively and fast is not something which we have not decided on or we are not thinking of. We will certainly diversify. Today, we have a known gold loan portfolio of about 12%. Going forward in the next maybe 3 years, 4 years, etc., it can come to maximum of 15 or 20%, definitely, maximum of 20%. But then our forte has always been the gold loan sector, and we feel that there is a lot of business potential in the gold loan sector. Despite the fact that banks are also coming into this field, we are also able to grow. So there is a lot of potential. There are more and more people are getting attracted to gold loan. But then we also understand that we need to diversify also, diversify into other loans. So housing loan is only one small portfolio. We have started the salaried personal loan also, and there's very small portfolio of the vehicle finance. But those are all very minuscule. But of the 12% non-gold loan portfolio, I think about 7 or 8% is the microfinance, which is done by our subsidiary, Belstar.
Okay. So that 12% non-gold can go up to 20%, you're saying?
Probably, yes, in the next 5 years. So, yeah, yes.
So slow and steady, not aggressive. I think that is clear.
That's what I wanted to correct you, Prashant, that we will be looking at diversification, but not aggressively, because our forte has always been the secured.
No, by aggressive, I did not mean loosening your lending standards or anything. I was just saying to kind of, fasten up the process. But just one more thing. Last 2 or 3 our interactions over the last 2-3 months, actually more than that, you've been telling us that competition in the gold loan segment, which was intense, has now peaked off and actually is now more manageable. Just an update on that. Do you still feel that way, or have things picked up once again? Go on.
No, I think no. It is that competition from the banks are always there. See, we have only 5,000 branches. All the 25, 26 scheduled banks and PSU banks together have about a lakh of branches. So you can't compare their total growth with the Muthoot. But then overall, you see, the bank's portfolio is also growing. Muthoot is also growing. It is not that somebody is taking away somebody else's business. It is that both are growing. So more and more people are now getting, or more and more people, public are getting comfortable with their gold loan. That's the beauty of this now, because banks have also entered. So competition is there. It is definitely there. It is not that it has gone away, but competition is there in the business because everybody sees a potential in this business. The banks, the NBFCs, everybody sees a potential. That is why more and more people are entering. But nevertheless, we are able to sustain our growth also.
Okay, all right, Mr. Muthoot, we'll leave it at that. Thanks a lot for joining in, and all the best. That's Muthoot Finance talking about retaining their guidance of a 15% growth, AUM growth, and they say the momentum in gold loans is something that continues. But Biocon is a stock on our radar right now. The company has completed the wave 2 of the integration of the acquired biosimilar business from Viatris. The integration is for the North American markets, which is the largest piece by value for the biosimilar business, and just 60 days after the company integrated the business in over 70 emerging market countries. My colleague Ekta caught up with Shrihas Tambe, who is the Managing Director and Chief Executive Officer at Biocon, began by asking him about this latest integration and the next milestone. Listen in.
First, on the North America piece, having transitioned the largest piece by value, I think the important next steps for us would be to make sure we consolidate on the strong foundation that Viatris has built for us in this market. We're very happy that over 100 colleagues from Viatris will be coming over on the commercial side to Biocon Biologics. So the first focus for us in the immediate future would be consolidating the business that we have in North America. And then given that we have a series of products launching in that particular market in the coming quarters, we really are looking forward to growing the Biocon Biologics brand in the United States and in Canada. The third wave of our transition will, of course, be Europe and the other advanced markets, and we've said that we will do that before the end of this fiscal, and we are on track for that as well.
Okay. Well, let's talk about specific biosimilar opportunities in the US then. Aflibercept, the biosimilar which is used for macular degeneration and cancer. The company has received Health Canada approval. There is a judgment we do understand which is pending in the US markets. What is the status of that and approval timelines?
So this is biosimilar Aflibercept, a biosimilar to a drug called Eylea. And we have a first-to-file status here from an asset that we acquired from Viatris as a part of this deal. You're right that we are in a litigation with the originator in the United States, but we have received conditional approval from Canada, and also we have the recommendation from EMA in Europe. So we feel very confident about the science, about the dossier. And I think we are looking forward to the outcome of the court proceedings. to see how we can bring that product to patients in the United States and other parts of the world.
What is your guidance then on the launch of the diabetes biosimilar insulin aspart? Have you heard from the US FDA on the 8 observations which were issued to the Malaysia facility? It wasn't a product-specific inspection, but nonetheless, if you could guide us on that. And the launch timeline for bevacizumab as well.
Yeah. So as you rightly said, Ekta, this wasn't the inspection that we had in Malaysia wasn't specific to aspart. It was a CGMP inspection. And we went through that inspection. We feel very confident. We've talked about it in the past as well. We've responded to the observations with a very comprehensive CAPA plan. And we're looking forward to hear from the agency on what they, whether these CAPAs are acceptable to them. On aspart specifically, we believe we should have an approval towards the end of the year, but we haven't heard from the agency specifically as yet on that. We've heard that they would need a pre-approval inspection. We will seek clarity whether they will accept our current inspection towards that end or not. On bevacizumab, we've said that we've responded to the CRL. So we have sent our comprehensive response to the agency, and we are quite confident and hopeful that the agency sees the responses as adequate, and we should have that approval coming over as well soon.
Okay, and what about adalimumab? Is there also an interchangeable opportunity there?
So adalimumab, we've already, as we got that asset over from Viatris, that particular interchangeability trial had already been started. So that interchangeability trial is currently ongoing, and we will see that interchangeability status come to us over the coming quarters.
What can you guide us as well as the market when it comes to your total debt on books, which stands at around $1.4 billion?
So as we've said, even in the past, that we feel very comfortable with the level of debt that we are operating under at this stage. We understand very well that historically we've been a very debt-free organization, a company that has not had any debt on our books. So it's very different from what we're doing. But we are also right now realizing a very transformational opportunity from where we were before the acquisition to where Biocon Biologics is going to be. So it's a very, very unique opportunity for Biocon Biologics. We feel confident given the response that we're seeing for our products, not just in the United States, but in Europe and other parts of the world, that the operating performance being strong, we'll be able to service debt through the business performance itself. And we've seen, interest in equity fundraise that we talked about in the past. And you should hear from us, in the days ahead on how we performed against that piece as well. So we see this debt at a comfortable level, but we will look to bring this down, as we've said in the past, in the coming days.
To how much? What would a comfortable level be?
Yeah, and I think it's really a question of, when we are clearly, creating value in the organization, then do we really dilute in the immediate term? At what value do you dilute? And then do you want to hold on and do this when you've actually created more value and closer to the IPO? So these are some of the questions that we would be dealing with. And we will have to make a determination of what that right debt to equity ratio would be before we make that call. I'm not going to discuss specific ratios today, but clearly we will be moving from where we are today to a much better ratio.
And what about the IPO?
On the IPO too, we've said right now our focus is that we will consolidate this business. We will integrate the Viatris acquired business into Biocon Biologics. You're seeing that we had a 2-year TSA with Viatris, but we've been able to significantly accelerate that period. All of this goes on to say that the organization feels confident. We believe that we should be in a position to at least be a year ahead of what we said in terms of the integration plans will then be the right time to start discussing the specifics around the IPO timing.
All right, that is the latest from Biocon Biologics. With the Viatris acquisition now fully integrated, we will take a break. On the other side, excerpts from our exclusive conversation with Axis Bank's Amitabh Chaudhary coming up in just a bit. He speaks about, of course, growth in the business and competition from fintechs from the sidelines of the Global Fintech Fest. Welcome back. You're with us on Corporate Radar. Let's move to the next interesting piece of sort of corporate conversation that we have for you. And this is a CNBC-TV18 exclusive from the ongoing Global Fintech Fest. Our colleague Ritu Singh caught up with Amitabh Chaudhary, MD and CEO of Axis Bank, and began by asking him about the competition from fintechs to banks and if there's a headroom for fintechs to take away customers and a part of the profit pool as well. Take a look.
You know, when you talk about the regulations can act as a moat only for a short period of time.
Yeah.
End of the day, if fintechs come with the right innovation, the right product, the right customer journey, I think they can continue to take customers away from the banks. And if you're not, we don't react or are not proactive about it. So in my mind, a couple of changes have happened post some of the regulations that have come in. I think the fintechs have had to rethink their model a little bit.
Yeah.
I think they have realized that regulation is not a bug, but is actually a feature which they want to have in their operating model, and a very critical feature.
Yeah.
So they have to put compliance with regulations fair and center of how they go about building their business models. And I think that realization has dawned very quickly, and a lot of fintechs are repivoting their model. But there are large fintechs out there who are providing services to customers, who are interacting on their platforms in very large scale.
Yeah.
So from a bank's perspective, the reaction to whatever is happening is, I would say, twofold. One is you first continue to innovate yourself and ensure that you continue to attract customers directly.
Yeah.
And second is that you work in partnership with all these fintechs because they are attracting a customers of a certain kind who are using a certain service. In many cases, a bank can come in and supplement and complement what those platforms are doing. And that's precisely what, say, a bank like us is attempting to do. We have huge number of partnerships, some very, very marquee partnerships.
Yeah.
And I think we're only building them over a period of time.
Let's broaden the pool a little bit because, public sector banks that have been saddled with bad loans are coming back stronger with cleaner balance sheets. You have larger private entities being created, your former HDFC Bank merger. You have Jio coming onto the scene. Aside from fintechs, who's the biggest competition for Axis Bank at the moment?
See, all our competition, and the competition is evolving as you rightly pointed out, that public sector banks are coming back, fintechs are becoming more important and prominent, Jio Financial Services are talking about making a big play in the market. The good news is that Indian opportunity is very large. It is only growing. The fact that all of us are here and so many people are here, they see India as a place where a lot of innovation, a lot of growth can happen in a short period of time. And I think it's a question of how you play on that opportunity rather than all the time worrying about, I have a certain scale and how do I protect myself. I think you should be thinking about how can you grow in this platform which is going to get created for India in a very, very big way in the years to come. So yes, competition is welcome. Competition will always be there. It will always, new competition will keep coming. It's a question of how we react to it. I mean, at least in case of Axis Bank, we are seeing this as an opportunity, and that's exactly how we're going about it.
So let's talk about Axis Bank, for instance. It's been a stellar first quarter for most banks. But, one thing we've been seeing playing out is the pressure on margins because of the liabilities getting repriced. In a scenario where inflation is high and RBI may continue to hold rates for a while, what will that mean in terms of your margins and growth outlook?
So the repricing of deposits is still in play. It's not that the repricing of all the deposits has happened, which means that the net interest margins will remain under pressure for a little bit of time. Yes. Obviously, every institution realizes that and is trying to ensure using a combination of what kind of asset classes you're pushing, what kind of yields you want to push, if and when the interest rates are cut. Because then again, the loans will reprice faster than deposits. You would see net interest margins coming under pressure. So I think that is some distance away. But in the interim, as pricing of deposits completes, I think the margins will remain under pressure and then hopefully stabilize till the the interest rate cuts start.
At 22%, your advances growth has been strong in the last quarter. But deposit growth has been lagging, and that's a problem that the industry is also facing. I wanted to understand going ahead, if this gap continues to widen, won't it affect your ability to disburse credit? How do you see that remaining?
Well, it impacts the ability of the entire industry to continue to
Let's talk about
credit.
Axis Bank.
Yeah, so in that sense, yes, at some stage, the deposit growth does need to catch up with the credit growth. Otherwise, we will struggle to, continue to grow advances at a certain pace. As you again rightly pointed out, that the growth on the CASA side has been slow. I think what you will see is a lot of banks are doing very well in terms of growing their term deposits. But yes, I cannot take away the fact that if deposits growth remain muted, at some stage credit growth will get impacted.
Mr. Chaudhary, to quickly also touch upon your latest deal that's been in the news. You've announced an additional 6% stake in Max at a price of 113 rupees per share. How do you justify the price and how do you think the regulator will look at it, given that currently Max is trading at, say, 890 or so a share, and a large part of that business is the insurance part of the business? So do you think there's a bit of a regulatory overhang there?
No, so I think when the regulator revised the guidelines, it made it very clear that the methodology for determining the share price has to be on the
fair pricing formula.
We have followed exactly the same formula. There was a transaction which happened in Max where Mitsui moved from Max Life to Max Financial Services, where a similar formula was used. They, at that time, had done the transaction at somewhere in the mid-80s. Okay. So it is not that we are using some different formula. We are following the guidelines issued by the regulator, and we are following the guidelines to the T. Now, again, this is all subject to approval from Reserve Bank of India and IRDA, and we will go through that process. Our view is that, firstly, a transaction of this nature has happened in the past, and we obviously continue to follow the same guideline in doing this transaction.
And, yet we've had the insurance regulator questioning Max, seeking certain clarifications in the deal. We also had SEBI recently, seek these clarifications. Has SEBI reached out to you on the matter yet?
See, when the initial questions were raised on the transaction itself, and I'm talking about
the last transaction.
Last time, at that time, as part of the inter-regulatory governance, I think IRDA had informed SEBI and RBI about the questions they had raised and some of the discussions they've had with Max and Axis Bank. I think it's part of the same thing. There's nothing new has happened which I'm aware of. So the regulators do talk to each other, and as part of that transaction, they were talking to the other regulators and sharing with each other what exactly the nature of the transaction was and how it has panned out. And I think this latest article or this news item which has come around, SEBI is just related to that, nothing beyond it.
But, SEBI is in the last leg of its investigation as far as your first transaction was concerned. And, it's estimated...
I'm not aware of anything of that nature, so when SEBI reaches out to us, we'll let you know.
Well, compared to the 32 rupees per share price then and 113 rupees per share price now, it is estimated that shareholder loss could be 1,800 crores or so. How do you think this would play out in the regulator's eye?
First, please understand that all these transactions are done with the permission of all the other shareholders. You're not going and doing something in isolation. The other shareholders of Max Life approve this transaction, only then something like this goes through.
Sure.
So it is not that it is done at the cost of someone without their knowing about it. It is all done with agreement of everyone else. And as I said, we have just announced the fact that we intend to do this transaction. We still have to go through the approval process. let the approvals come through. Then we'll actually do the transaction.
You know, the Citi deal, that's another one that you've now finally been able to close. Has it played out the way you anticipated? What are the synergies you've seen since the 1st of March when the integration was completed?
Well, it has played out exactly the way we thought it will.
Despite Citi losing a lot of customers in the process?
No, that is all media. See, again, please let's understand. When Citi started talking about this transaction in the first place, that was in March 2021. Then they came to the market with the deal in June, July 2021.
Yeah.
The transaction was consummated on March 1st, 2023.
Yeah.
Now, during that process,
Yeah.
Citibank might have lost some clients.
Yeah.
And it is obvious that when you do something of this nature, you will not only lose some clients, you'll lose some employees also. And that has happened.
No doubt.
In our structure with Citi, the transaction which we had kind of signed up with them, we had mitigated the risk of something like this happening. And you did see that the overall value which we paid to Citi did come down because they had lost a certain set of customers, which is beyond the framework which is set up.
Agreed upon.
Post the acquisition, both on the employee and the customer side, I don't know where media is getting its numbers from because we are not disclosing any numbers. We are just saying that the 97% of Citi employees came to us.
Yes.
The attrition rate is lower than what they saw in the 2 years before the acquisition. And the customer retention has been extremely high and as per our expectations.
You know, my very last question to you. Recently from Axis Bank, we've had Neelkant Mishra being appointed as the chairman of UIDAI. Just quickly wanted to get your comments on that.
Well, congratulations, Neelkant. I think it just goes to show that we are attracting talent of the highest order. And, you know, we obviously encourage our people to engage with the government and get involved in some of the policy-making issues. Neelkant has been at the forefront of this for quite some time, and we are just truly delighted that he was seen fit to be appointed the part-time chairman of UIDAI. And I hope more people like him get appointed from the Axis fold over a period of time. So, quite delighted.
Okay, well, that's an interesting conversation with Axis Bank CEO and MD, Amitabh Chaudhary. My colleague Ritu conducting that interview. Wide-ranging, I mean, actually, and we'll continue to play snippets of that conversation through the course of the day. Well, you know, you got the market, which is looking down, but out 24, 25 points lower, 19,586 is where we're at. Maybe with 45, 50 minutes of trade behind us, it makes sense to look at the market breadth, and that'll give you a sense of the health of the overall market, which is absolutely fine. You know, 1,300 stocks are higher, and you've got 740 stocks which are lower. This is overall NSE advanced decline, so no problems. Look at Cochin Shipyard, right? I mean, I don't know if there's any news flow here, but 15% higher on Cochin Shipyard. Stocks almost at 1,100 rupees. It is the biggest price volume gainer in the market. But it's not just Cochin. You know, the shipbuilders are back. Look at Mazgaon Dock, 5% higher. You know, it's almost like they go up 15, 20, 25% in a week's time, then they take a break, 2-week break, holiday, and then, you know, the move again starts again. Not Mirza, Mazgaon Dock is what I was talking about. 2005 on Mazgaon Dock. And you also look at Garden Reach Shipbuilders, which is nearing the 900 rupee mark. So 6.5% there. Stocks at 874. So all three shipbuilders, listed shipbuilders, doing very, very well. So that's a new kind of, you know, a new set of names which have come into this morning. We'll take a quick commercial break here. On the other side, we shift our focus to the commodity markets. Manisha is here with that in just a bit.
Welcome back to Bazaar Morning Call. Well, for now, let's get Mitesh Thakkar on board to tell us how to approach the markets. If you look at the headline index, there's not too much happening, but a lot of the action actually is in the mid-cap space. So the mid-cap index is now up about 130 points. Mitesh, thanks for being with us. What do you do on the headline index? And more importantly, any mid-caps or small caps where you can take a fresh positional trade now?
Good morning. So I think one, avoid the index. I was talking about the fact that around 19,650, 19,700, good time to exit the index, wait for a good dip to play in, and then try to get in back to the index. But stock specific wise, we had all buy calls, and I think the idea remains to find these breakouts which are succeeding in the mid and the small caps and try and take longs over there. Even apart from that, I think in the large cap space also we are trading with long buys. So it's a very stock specific long kind of a market for me, while we have been totally avoiding the Nifty, the bank Nifty till for many days and Nifty since yesterday. So I think that's the way we'll approach it. And on the stock side, cement as a pack is looking very strong to me. So I have a buy on Ramco Cement. That's a buy with a stop just below today's low of 902. Keep a stop at around 900 and look for a target of around 930 to begin with over here. And the other stock which I like is Gas Authority, not exactly a mid cap, but it's been making fresh highs. So GAIL is a buy with a stop at 123.5 for targets of 132.
All right, got that. Mitesh, thanks very much for the trading calls. With that, let's now move our focus to the commodity market, see what's happening there. Manisha is joining us now. Manisha, what's on your radar?
Well, I'm looking at the metal prices, and the last week or 10 days have been good for metals. Today, can't say the same about the sector because there is a bit of a decline as the US dollar index has surged back up yet again at 5-month highs. We're nudging that 105 mark there. And the markets also are reacting to the China trade data that came in today in the morning. While the surplus has been the smallest in last 3 months, it really is about the export and import number that the street is looking at. So when you look at the China exports, we're looking at 8.8% of a contraction on a year-on-year basis. But this is much lesser than 9.2% that the street was estimating. The Chinese import numbers as well has seen a decline, and this is a decline for 8th straight month, 7.3% of a contraction. Street was anticipating 9%. So in that sense, the numbers aren't so bad really. I want to take you through basic fundamentals for some of these metal prices. Aluminum today, of course, has opened slightly on the weaker note, but even with that, we are trading at a 1-month highs at this point in time. And that is after China has halted expansion of production capacity beyond 45 million tons. This has been done to ensure that there is not excess supply in the international markets. And then Indonesia also banning bauxite exports, which is the major ingredient for aluminum, has been supportive. So when you look at the last 1 week or so, aluminum prices still are trading in the positive there. Iron ore, let's talk about that one, and that has seen a phenomenal run up. 4-month highs at around $117 a ton. I mean, for iron ore, most banks and brokerages kept telling us that 100 is going to be a resistance, but a very strong run up. And that is because the steel demand, steel output in China has been on the positive side. The higher steel output also has taken the nickel prices to nearly 1-month highs. Apart from that, here as well, it has been about tight supplies in Indonesia. It also has to do with delayed quota system or allocations that Indonesia is looking at, and that has been supportive. Also, demand from steelmakers being on the positive side has taken prices higher. The only metal that has actually underperformed in this week has been copper prices. We have seen prices decline because the yuan is trading at a 10-month lows versus the US dollar, and copper is more in sync with the macro numbers, and that haven't really been very strong. For copper though, even here, if you look at the prices that we saw in the month of August at around 8,100, we are trading at around 8,400. So here as well, we are trading on the positive side. So on a week, on a month notice, we are still positive. It is today that the markets have reacted slightly weaker.
All right, thanks a lot, Manisha, for that. Well, let's do one thing. Let's talk about some of the buzzing stocks. Ind-Swift Laboratories is on our radar. Mangalam is here to tell us why he's tracking that one. Mangalam, over to you.
Well, the stock was up 20% yesterday after an announcement of the deal, and that is when we alerted the viewers as well that the deal is, there are curiosities in this deal itself. The stock is now down 17% on account of the same. And this is not a comment on the quality of the business, but more on the nature of this transaction. So let's tell you, the company yesterday announced that they've sold their API and CRAMS business to Synthemed Labs Private Limited for about 1,650 odd crore rupees. For that, they said that they had 800 crore of debt, and that meant the valuation of the company's equity was around 850 odd crores. This was at a premium to the last market cap of the company, which was 730 odd crores, and which is why the stock moved higher. However, if you just take a look at it deeper, you would realize that the company has effectively sold its entire business, because the turnover of the business that was sold was 96% of the company's overall sales, and they sold it on a slump sale basis. What the street would have actually liked is had they sold it effectively on a whole basis, and as a result of which the minority shareholders would have gotten an open offer as well. But the next step was that now that they've sold this business, what do they do with the money? Would there be a big dividend or not? Well, at the same time, the board also approved grant of unsecured loan of up to 600 crore rupees to Ind-Swift Limited, which is a related company itself, and then eventually there would be a merger of Ind-Swift Labs with Ind-Swift Limited. So one would be a little curious about what Ind-Swift Limited does. At the same time, their board also approved raising debt limit from 1,500 crores to 2,000 odd crores, and for that, Ind-Swift Limited had a market cap of just around 120 odd crores. So all of this piqued the curiosity, and perhaps the street doesn't like this, and as a result of which the stock is lower today.
All right. So, yeah, there's a big one, 17% lower, and interesting one, Mangalam. Thanks very much for highlighting that for the viewers. Now, Keynes Technology is the one which is jumping up once again. Vivek is here with more on this one. Vivek, morning.
Well, good morning. Earlier today we highlighted, how CLSA had written a note on all of the EMS companies. They initiated coverage on Dixon, Amber, as well as Keynes. We are highlighting Keynes. It's a sharp mover in the session so far. What CLSA has to say is that, number one, they have an outperform rating on the stock, target price of close to 20 to 30 rupees a share. What they're saying is that the company is likely to benefit from India's thrust as far as electronics manufacturing is concerned, and it's a well-diversified services player. Along with that, what they're saying is that the company has presence across key industrial segments and low customer concentration that they see is a positive. Along with that, they are quite positive as far as the three-pronged strategy that the company employs in terms of raising capacities, improving backward integration, as well as new capacity and customer addition. Along with that, given the fact that Keynes has a higher exposure to automotive, they believe that it would be a key beneficiary from the thrust seen over there. Lastly, what they're saying, the order flows as well as the strong order book that the company is seeing gives confidence of a strong growth over the next 3 years. They are actually anticipating a 39% CAGR return in terms of revenue from FY23 to FY26. They believe that the company actually will enjoy a higher margin mix than global peers, which is why they continue to remain positive on the stock.
Okay, thanks a lot for that. That's Keynes Technology up almost 5% odd. Let's slip into a quick break. On the other side, it's our special segment. It's the economy. Lata will get chatting with Chetan Iyer, the chief Asia economist at Morgan Stanley, on the kind of economic slowdown that we're currently seeing.
Welcome back. Today on It's the Economy, it's a China special. China's economic slowdown seems to continue with the latest data showing that August exports fell 8.8% in dollar terms, while imports fell 7.3%. Now, will the Chinese government and the PBOC come with more stimulus measures? According to Morgan Stanley, the big problem with China is their over-leveraged local governments and the crumbling property sector, of course. To understand more, I have with me the chief Asia economist of Morgan Stanley, Chetan Ahya. They've written a bunch of excellent reports on this issue. Chetan, good morning, and thank you very much for sparing time for us. Well, for starters, can you tell us your diagnosis of the real problem that's pulling China slower?
Well, Zana, what we've described is that China is going through this 3D problem of debt, demographics, and disinflation all coming together. So their age dependency ratios are rising. Debt to GDP has increased by about 30 percentage points since December 19. And GDP deflator has gone into deflation of minus 1.4% in the second quarter of this year. So combination of these three is resulting in a dynamic where China's nominal GDP growth has decelerated quite significantly. We expect it to be just 2.5% in the third quarter of this year. And that's making things very difficult for investors, because if your nominal GDP growth is so low, it becomes very difficult for the corporate sector to generate profits, and that kind of is resulting into a vicious condition for China right now.
Okay. So now what are you expecting in terms of the Chinese PBOC or the government? At the moment, what have they done? They've just done, what, 20 basis points rate cut? They haven't really come with a volley of measures.
Yeah, look, interest rates are already low. So policy rates are down to 1.8% after this 20 bips cut. And when you have GDP deflator and deflation, your real rates are going to be high. And there is very little that country can do or central bank can do in terms of cutting interest rates and stimulating through monetary policy. So we think that the key to China's recovery now is a fiscal policy. And at this point of time, they are still holding back on fiscal easing. In fact, in the first 7 months of the year, they've tightened their fiscal deficit by 5.5 percentage points. And this is actually somewhat comparable to what we had seen in Japan, that once you go through this major deleveraging-led slowdown, policymakers tend to stay hawkish for longer, and that actually creates their challenges or exacerbates their challenges, because once you get deflation, it gets very difficult to revive the economy back.
Can you explain a little more of your argument on why you say there is a debt and deflation loop? Your argument is that the local government financial vehicles are over-leveraged, right? Not the central government.
That's right. So in terms of the part of the economy which is in deleveraging mode right now is local government funded vehicles. That's about 45% of GDP. And if you take the formal bond issuance by the local governments, that would be another 25-30% of GDP. And then the third component is corporate sector in the property segment. So that's about 25% of GDP. So when you take the total of these three components, it's about 100% of GDP. That's the magnitude of balance sheet which is in deleveraging mode. And when you have such a large part of the economy that gets into deleveraging mode, you will get slowdown in growth rate, or what we as economists would call it as aggregate demand slowdown. And therefore you get deflation. Now, to get out of this debt deflation loop risk, they need to kickstart with fiscal expansion and stimulate aggregate demand. They can do it with initially with infrastructure. They have energy transition related capex to do, so they can take that up. But in the medium term, it has to be done through consumption, and for that, the government needs to take up fiscal transfers, or call it social welfare spending. They would not do that direct transfers that the US did, or even in some ways India did. they will only be probably focused on social welfare spending. But even that is not being taken up right now. So, they have to, in the near term, kickstart through infrastructure, but from a 12 months to 24 months perspective, they have to start moving towards consumption through government spending on social transfers.
Okay. Chetan, I mean, when I read all your excellent reports, it occurred to me, is this in a very remote way like what India went through with its state-owned banks, and even for that matter, some private banks, during the period 2016 to 2018, they could not lend because they had huge bad loans, and, the government had to help out with recapitalization. So this is something like that. They have to recapitalize their local government financial vehicles so that the debt is removed and they can start lending. Is that what you're saying?
Well, these local government financial vehicles are, Lata, in form of comparable to infrastructure companies.
Okay.
So banking system so far is okay. They are relatively well capitalized. They'll, of course, go through some NPL rise because of the property sector. But these local government funded vehicles are largely government vehicles for infrastructure like utilities, etc. And the problem there is that they had actually created these corporate sort of entities to do infrastructure related spending. And they raised from banks and the local markets at very high rates in terms of their borrowing. And that is, let's say right now, it's believed to be about 5% cost for them in terms of the funding rates. And then in the meantime, they were able to service this debt with property sales and property sales revenue, which has now collapsed. And so they have a challenge in terms of the revenues to service this debt. They have a challenge in terms of revenues to even do their normal spending, which they anyways have to do for maintenance of their government activities. Because property-related land sales value was accounting for 40% of local government's revenues. So it is actually some kind of government, pseudo-government entities which are in trouble. And they now need to find a resolution for these local government-funded vehicles, which would be entailing some kind of debt swap with the central government. They'll have to renegotiate the interest rate and the duration for which that loan is to be paid by. So that effort is underway. We haven't yet known the formal plan from the government, but we're expecting that to be announced by October, November. But that will have to be done. And then, the key thing is that, when you are dealing with this past debt issues, that is still addressing the stock of the balance sheet or the balance sheet problems. But you also have a growth problem. And so while you are doing this adjustment in the balance sheet and restructuring of debt, they still need to figure out a plan to create support to aggregate demand, which, as I was suggesting earlier, can be done through fiscal expansion.
Got that. Now, just tell me, what should the world take away? I mean, commodity prices are dependent on what China would do. A whole host of things we buy and sell are dependent on China's growth. What should be the message for the world? Will China continue to be a disinflationary force for a better part of this year because it may not come up with such a big fiscal stimulus?
Yeah, I think the bottom line is that China will remain a disinflationary force for the world in the next at least 6 to 12 months' time. And the other way to think about it is in terms of the details of that transmission of disinflationary pressures will be through trade, commodities, and financial conditions. So trade is, China is a big partner for everybody, and everybody's core goods inflation will be seeing downside pressure because of China, and corporate sector will suffer lower pricing power. For DMs and even for some of the EMs like India, this may not be necessarily bad news because we do have some inflation pressures right now. And so this disinflationary pressure that China would sort of emanate through goods pricing would be somewhat beneficial, but it will be one major way in which China sends disinflationary pressures to the rest of the world. The second is commodities. Now, in commodities, it is not as simple to say that all commodity prices will go down. What we are observing is that China is still continuing with energy transition-related capex. And so some of the base metals like copper, lithium, even to some extent aluminum, if you look at the domestic demand, that continues to be doing well. But it's really long steel products where prices are getting impacted, because that is where the property sector slowdown is weighing in quite aggressively. And then finally, the third source of impact, as I mentioned earlier, is financial condition, and that's basically through currency. And so you've seen that RMB has depreciated. And if you go back to looking at Japan in the 90s, once Japan saw inflation in fourth quarter of 1994, its currency from that point of time remained constantly weak, and its trade-weighted exchange rate kept depreciating. So if China doesn't get out of this debt deflation loop, I think this disinflationary pressure that I mentioned to you for the next 6 to 12 months could get extended, and this would be like a persistent disinflationary force if China doesn't get out of that debt deflation loop.
Okay. Well, just for the record, as Chetan is explaining, the Chinese renminbi is the weakest it has been since November 2022 at 7.3 to the dollar. And as he says, it could get even cheaper. So there will be that pressure on India as well to not, to have to react to this. Very quickly, Chetan, final question. Does that make India a more attractive prospect?
India definitely does look as a good alternative destination. From two perspectives, we are seeing multinationals are looking at India as a growth opportunity which they need to have a presence in. And at the same time, the global portfolio capital allocation is also having to move more towards India as an alternative, which is an attractive destination. So India is definitely benefiting on account of this. And as I mentioned earlier, if you get softer commodity prices or lower import prices for goods, that's helpful for India in terms of management of inflation as well. But I think the bigger story is, if you think about that 3D problem that I described for China, what that results in is a much weaker nominal GDP growth.
Yeah.
And again, borrowing from that Japan's experience, nominal dollar GDP will also be stagnating if China cannot get out of this debt deflation loop. Whereas, in India's case, it doesn't have this 3D problem. Nominal GDP growth is fine. And to the extent to which India's real growth will be much better than rest of the world, we think that in terms of dollars as well, India's nominal GDP should continue to rise much faster. So when you're looking at China versus India, for investors, if they approach it from nominal dollar GDP opportunity perspective, then India will increasingly look far more attractive than where China is going to be.
Okay. On that very optimistic note, Chetan Ahya, thank you very much indeed for joining us and explaining in such detail the problem with China. We will keep touching base with you to check out whether the Chinese are taking a leaf out of your reports and encouraging that fiscal transfer, which is most needed in China at this point in time. Not monetary stimulus, but fiscal stimulus, as Chetan explains. We have to wrap up on that note on Bazaar. After a brief break, Chartbusters.